my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of Paris rapeseed, Winnipeg canola and Malaysian palm oil markets. I'll start with Paris rapeseed. The most significant, relatively recent event here was the combined bearish dark cloud cover pattern and bearish double made on the 23rd of March. As an action on its own, it was not that significant, but it did allow the creation of an upper trend line for a smaller ascending narrowing wedge pattern. The lower trend line for this pattern was created just after. The upper trend line is a multiple pointer, whilst the lower trend line was only 2 points. At the end of April, with the changeover, prices gapped down below the lower trend line, allowed for some targets to be drawn on the downside. A primary target X in the 756.5 area and a secondary target X1 in the 692 even area. The primary was at that time a big ask on the downside, a big ask, even given some of the recent large ranges we've seen. This leads me to a side track, if you like. You see, there had been, as I've repeatedly said since my annual review on Paris rapeseed back at the very start of January this year, there had been some big patterns in operations here, and a big ask such as this one was in order. And going back to my commentary from the start of 2022, and I quote, "This leads to my final points. Since May last year, that is May 2021, we have formed a newer, much more acute bull channel, currently 670.75 to 892.75. To me, it's super acute and thus unsustainable, but it is there, and I will not dismiss it just because of acuteness. Well, what I initially saw as a super acute bull channel is still there, and I've transferred it and finessed it here on this daily chart, such that I see it now more as the February/April 2021 to date larger ascending broadening wedge pattern rather than a bull channel. This pattern has been the outlying corralling, if you like, bullish influence on this market, despite what may be happening on a daily and even weekly basis. This pattern had been showing the way higher all the time. Now, there had been some moves up and over the upper trend line during April, even trading a full week above and outside it, but, and this is an important but this was and is a monthly pattern we are talking about here, and though we have had the one monthly close for April above and outside it, looking at the relative limited size of the action seen outside the ascending broadening wedge pattern, I've always been looking for further confirmation of any such bullish intent, which in the following month of May was not forthcoming, and now in June looks even more so not forthcoming. You see, though we had that push up over the upper time, the market has not sustained the move higher, and we made in the middle of May, as I've repeated in every commentary since, a very, very, very significant weekly key reversal down to counter any such bullishness. Since then, we have seen the follow-on lower. A few weeks ago, I drew a small late April to middle May bearish shift pitchfork. The middle time, currently at 777, has been excellent in showing the bearish angle of attack since its inception, and prices had been moving slowly lower towards target X in the 757 area. Now, before I speak about target X, I wanted to once again let you know that I was very much aware that sneaking up from below was the medium moving average, currently 765.5, as well as the nearby 50% Fibonacci line for 2022 at 745.5. I cautioned consistently to watch out for these two forces below, as they may seem supportive, but they could also be trigger events as the market approached both of them. Well, the trigger was pulled over last weekend, with the market only closing for a third consecutive time below the rising medium moving average, and the third day the market reached target X, but also this past Monday gapping lower and moving below the 50% Fibonacci line at 745.5. It was only the lower time, currently 730 even, of the bearish shift pitchfork that halted the fall. But that did not last as long, as on Tuesday we had a second gapping move lower, that moved and closed below the lower time, and most importantly moved below the rising long moving average, currently 717 and 3/4. At the last moment, prices closed just above the long moving average. And yesterday we had another gapping move lower, the third in succession, with a second bearish opening black Mariposa in succession as well. This time the market reached down and closed below the harder to get secondary target X1 for the old ascending narrowing wedge pattern in the 692 even area. Today things have continued in the very bearish vein, with what looks right now like another bearish opening black Mariposa that has gapped down through the February 2021 to date optimized uptrend, currently at 683 and 3/4, and super importantly down through the lower wedge trend line, currently 670 and 3/4, of the February/April 2021 to date large ascending broadening wedge pattern. This is a supreme event, but it should be treated cautiously. You see, as I treated the breakback in April with caution, so will I treat this one. The very least I will do is wait until I see what happens at the end of the month, as in next week. Meanwhile, if we look below, we have the interesting 50% Fibonacci line, the December 22 to April 22 move, or sorry, December 21 to April 22 move at 644 even, the March 21 to date uptrend, currently at 632 even, and a combination of the February 22 low at 599 and 3/4, and the continuation of the neckline of the April to June 2021 head and shoulders pattern, currently at 599 and 3/4 also. I have a suspicion that these last two may well play a considerable part in the future of this market. Going forward, the bearish shift pitchfork and the optimized uptrend will both now be retired. Winnipeg canola. The peak of the market in late April was with a 3-day bearish evening star pattern. This caused the dramatic drop at the start of the following week, which we're still seeing the effects of even now. The next bearish event was the gapping lower after changeover in mid-May. After that, the next bearish event was when prices dropped down through the significant February high at 1092.20, as well as the slowly rising medium moving average, currently 1082.80, and entered a fairly free territory below until the wide band of congestion between October 2021 to February 2022. That's between 942.5 and 1030. It's not an easily defined area, and it was as various different strata of support and resistance. Perhaps the most immediately recognizable is the flatlining long moving average, currently 1021.20. For a number of weeks prices tried to go down through this long moving average. Only when I was commenting last week did the market manage to breach it, but it was only on the following day, that's last Friday, that prices finally managed to close below it and set off an explosive move lower, akin to a dam bursting. Even then, it was surprising to see how the market not only punched down through the wide congestion bands, but how quickly it managed to do it. This led me to an observation last week. You see, I originally drew an acute bearish Andrews pitchfork for the late April to mid-May move, and it had worked until 2 weeks ago, and then started working again this week. I'm in two minds whether to keep it on or not. For the moment, I'll keep it on despite wishing to retire it last week. Looking at what possibly can halt the decline. Well, neither the 50% Fibonacci lines of the January 21 to April 22 move at 921.70 nor the October 20 to April 22 move at 863.80 have made a dent. But the September 2021 low at 839.20 has today. So much so the August 2021 low at 817, and then there is of course the March 2008 high, the previous all-time high at 770 even. Let us not forget the lower time, currently 822.20, of the thoroughly wrecked but seemingly still useful bearish Andrews pitchfork. Bursa Malaysia crude palm oil. The bearish opening black Mariposa made 3 Thursdays ago that I highlighted last week was not, as I suspected, the trigger that set off this huge move lower, but it was the finger moving the trigger backwards. It was the next days, that's the Friday, in a shortened week, that triggered the move lower by significantly closing below the medium moving average, currently at 63.32. Prices temporarily halted at the middle time, currently 57.67, the newly drawn late April to late May bearish shift pitchfork, before resuming last week their journey lower. On Thursday of last week, prices on one day gapped lower and closed below Fibonacci congestion at 57.10 and 56.89, plus the 50% Fibonacci line of the January 21 to March 22 move at 56.42, as well as the long moving average, currently 56.44. Over the last weekend, prices gapped lower again, opening on the lower time, currently 51.44 of the bearish shift pitchfork, and pushed under and closed below the September 2021 today uptrend. That's currently at 52.10, and also filling in old gaps from an island bottom from back in January. The hesitation of an indecisive spinning top we saw this past Tuesday was only temporary, as yesterday saw a huge bearish long black Mariposa that punched down through and closed below the 50% Fibonacci line of the July 19 March 22 move at 49.64. It is only today that we have seen the first sign of a bullish action for 12 sessions of a bullish harami. I suspect Wednesday's halt in decline and today's move back up may be due to the same reason: the March 2008 previous all-time high of 44.84. Below this we have the August 2020 today uptrend, currently at 44.17. Now, I will now draw your attention to the last part of my commentary from last week, where I dealt with ideas for a possible bearish scenario just like the one we have since encountered. And I quote, "One final thought. If we take December 2021 today action as being a really big double top, even Adam style, then we have some potential targets below, if this does turn out to be the case. Therefore, such a pattern, primary target X would be in the 48.15 area, whilst the harder to get secondary target X1 would be in the 39.70 area. The latter is off the bottom of my daily chart. There are early looks. These are early looks at what might be, and it is not yet certain if they will happen, but I thought you should know." End of quote. Well, target X in the 48.15 area was reached yesterday, and target X1 is now just showing along the bottom of the daily chart. One final thing to look out for: we have a potential dead cross in the offing of the falling short medium moving average, currently 63.84, possibly through the declining medium moving average, currently 63.32, and that's in the next few days. This is a lagging indicator, but it is worth considering, especially in the current climate. Thank you for listening. This weekly broadcast gives essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyrights Eddie Tofpik and ADM Investor Services International Limited. And here comes the final bit.